It's getting better all the time. I used to be bad in my school. Teachers that taught me when cool. Holding me down, turning me round, building me up with your rules. To admit it's getting better, time by time, all the time.
Good evening, everyone, and welcome to the September 2nd edition of Bond Squad After Hours. I'm your host again, Tom Byrne, Director of Fixed Income at Wealth Strategies and Management / Bond Squad. Of course, our disclaimer, investment advice is offered through Private Advisor Group, a registered investment advisor. WSM LLC and PAG are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results, in spite of the fact that global investment committees always use past performance to indicate future results, which is my little addition, not part of the official disclaimers. And good evening, everyone, and welcome to Bond Squad After Hours. And we started with the song by the Beatles, It's Getting Better All the Time, because we're in our 60s mode here. And it is getting better, and that's evidenced by today's Beige Book released by the Fed for economic conditions around the country. And the Beige Book indicated that the economy has rebounded from a slow Q1, Q2 picked up, Q3 it looks like it's hanging in there. We're seeing improvements in hiring still, especially on the wage front. All regions reported moderate to modest growth, or modest to moderate growth, and labor conditions are getting a little tight. So it is getting better here. Now, we did see factory orders drop in today's report in spite of healthy auto sales. So there's still some problems there. Construction spending is better. So we're seeing kind of lumpy economic data, but it's like a 2 steps forward, 1 step back. So things are getting better. And this potentially puts the Fed on the table for this month, which I've said in my reports and on these broadcasts many times. So now, is it a slam dunk? Well, I think it should be. I thought the Fed should have gone last year, and I have that in print. If anybody wants me to send them copies, I have it, because we're getting late in the economic cycle. All right, the expansion is getting a little long in the tooth. So the Fed probably should have gone last year. Now we're tasked with going while the rest of the world is going the opposite direction. And I do mean almost all the rest of the world. The UK isn't. Europe's kind of bouncing along. Japan is Japan. It'll probably always be Japan, which is moving along. China, well, China is a joke, a dangerous joke, but a joke. And too many economies were reliant on Chinese growth, just soft landing and rebound back up to close to double digits. Probably not going to happen. Anybody wants to make that bet with me, I will take the other side. All right, compliance. I'm only kidding. I'm not really engaging in bets, but gentlemen's bets, right? All right, so China has a problem. It's shutting down the markets for 2 days to celebrate the end of World War II, which ended in 1945. But, that was delayed to throw a good party. And as part of the festivities, China's now parked 5 warships off the Aleutian Islands in Alaska, 3 warships, a resupply ship, and an amphibious landing ship. A little ominous, but, they're the Chinese. You want to invest there, go ahead. I don't need to return that much to invest over there, where they're arresting journalists and sellers of stocks. Anybody who's negative, you just arrest you. Good luck with your property rights and your rights as an investor. That's the other thing, I guess, because we always want, get rich quick. The Ralph Crandon, and that's what we showed last week. All right, so we had good Beige Book, good Beige Book data, and puts the Fed back on the table. Not a slam dunk. I'd say it's 55-45 that they go this month. I think the Fed should, but the data support it. Now, right away after the Beige Book, we saw the equity market pick up, but look, a lot of that, and this is coming from the equity market participants. You'll be able to read it in various publications tomorrow, most likely. A lot of short covering going on, or position flattening today. So ahead of China being closed for 2 days, you're coming into employment data, End of the week, plus a holiday weekend, you saw some flattening out of maybe short positions. That's why the rebound was about half what the sell-off was yesterday. I still think there's more to go down or more to bounce around. That's to be expected. But China's been on everybody's minds lately. And the apologists for China, or the China minimizers, have pointed out that we export very little to China, which we do, right? It's I think it's less than 6% of our total exports. That's not the problem, all right? The problem is contagion to other countries with which we do more business with. And now we saw our largest trading partner, which is Canada. That's right, folks. Our neighbors to the north is our largest trading partner. They dipped into recession. A lot of this because they were selling minerals, raw materials, energy to Asia, particularly China. So it's like 2 degrees of separation here, where China slows, Canada slows, we can slow. Now, I did a branch visit today, and some people were worried about 2008. Some people said, well, we remember 2008. All right, guys, this is not 2008. The banks are not imperiled. They have balance sheets that could probably withstand the Great Depression, never mind the Great Recession. There's no systemic problem with U.S. banks here. It's not 2008. We're not going to see the financial system collapse. You could see some countries' economic systems or economies collapse. Watch out for Venezuela, watch out for Brazil, look for pain in China, look for Russia to do something crazy to divert attention from the true economic problems. That's where your problems lie. Could it shave growth off the U.S.? Yes. It could, 20 basis points, 50 basis points of U.S. growth. Maybe if we were going to go 2 3/4, we go 2 1/4 or 2, maybe 2.5. That's all I see us growing here. I don't think we're going to go 3 on average. I think we're probably a 2.5% economy. That 3.7 print was a snapback. New methodology and snapback. So we're probably in a 2.5% economy thereabouts. Now the question is, can the Fed or should the Fed tighten? The answer to both is yes. They can and they should, at least in my opinion. Already, those who have bet the wrong way, and you can tell they're talking their books. They're out there saying, no, the Fed can't do this because it for a psychological effect, it'll make people take risk off. It'll cause companies to have difficulty obtaining financing, so on and so forth. It might even constrain lending as lenders don't believe that the Fed is going to be one and done. I think they're going to be one and done for this year, but no, they haven't done that before. Yeah, the world's been this way last time was never. Okay, so it's a psychological thing. So people are leaning the wrong way. They're caught leaning off the first, and if the Fed tightens, they get picked off. All right, so they don't want the Fed to tighten. All right, honestly, going from a range of 0 to 1/4 to 1/4 to 1/2 on the Fed funds rate is probably not going to do a whole lot to slow the economy down fundamentally. Psychologically, yeah, what, the Fed's not in any. If you took too much risk, you're too much on short-term outcomes. If foreign central banks, were advocating policy responsibility to the Fed, it's their problem. It's not the Fed's problem. The Fed has to watch here, and the Fed needs ammo. Right now, this doesn't mean the Fed's going to renormalize rates. That's the other side of the thing. Some people said the Fed shouldn't do it. Some people said the Fed should renormalize. Fed's going to do neither over the longer term. Normal Fed funds rates, even in this environment, are probably somewhere around 2.5. Probably somewhere around 2, at least in my opinion, right? Not the 3.5 to 4 they were before, but it's not 0 to 1/4. So the Fed has to get there gradually. Even if the Fed moves up to 1%, it's still accommodated. If you're bet the wrong way and the Fed going to 1% is going to blow you up, then you have a problem. But I'm not panicking. If I own investment grade bonds, municipals, large or mid cap stocks with good balance sheets and not a lot of leverage on the balance sheet, and that's the key, folks. Balance sheet leverage. If those balance sheets aren't leveraged, you're probably fine. Okay? Yeah, things might go down. So get something that pays a dividend. Remember, history said that if you look at the stock market, about 71% of total return is dividend. You can't reinvest. Don't underestimate dividends, but that's another story. So we're back to the Fed in China. All right. So what should the Fed do about China? Well, China's a mess, guys. I know Kramer said it the other night, and he was right. Do you really want to invest there? it was assumed, and why this was assumed, I don't know, that China's leadership could skillfully navigate through this, and that eventually they'll open up the economy because they know that deep down it's consumer freedoms and the freedoms of its population that matter. They're not looking for that outcome. It's not like they're saying, you know what, if you do it slowly, it'll be all right. They're like, how can we do this with granting as few freedoms as possible? And that's what they're doing. They're having trouble coming to grips that the only way out of this is, well, there's two ways out of this. You can open up the economy, give more personal freedoms, and also give the freedoms of businesses to fail, and go through a troubled period where the economy sorts itself out, businesses fail, investors back away from China for a while things sort themselves out, while we wait to see who fails and who doesn't. The other side of the coin, China can grab more control. Just don't let things go down. Don't let things fail. And they can try that. But at some point, a smart investor goes, I don't want to invest in that environment. Why would I want to do that? It's stupid. Yeah, it might work for a while. You did well in China for the last 10 years, right? But China was coming from last place to second place. Now the improvements would be incremental, not exponential, right? So, you know, it's crazy to think that's a persistent story. Meanwhile, India gets no respect. Now, India has its problems. It deals with corruption, you know, especially on the local and regional level, but it has 98% of the population of China. It has a British-based legal system. You have real property rights. English is the first language of business. Just have the largest economy. Also has English as the first language of business. Not to mention a few other important economies also have English as the first language of business. You know, India would, for a longer term, would seem better. Not that I think that's a slam dunk, but China, really, come on, okay. But China's inability to right its economy and its effect on the other emerging market exporters, especially raw materials, minerals, and energy exporters, is having an effect on the bond market and the currency markets. Right? We saw last week these foreign currencies weaken. Now, when the turmoil struck, it struck some people as odd. Excuse me. That treasury yield started to back up on the long end, started to rise a bit, and they couldn't figure that out. So I was out there figuring, okay, maybe what they're doing is they're selling their treasury holdings and then selling the dollar and buying their home currencies to defend it. Even China. Remember, China wants to devalue, but not too much. It'll float the yuan freely, but not too much. So, all right, all you global investment committee people out there who thought that China was doing this to move into the well-developed and legitimate economies. Sorry, you were hoodwinked again by the Politburo. So we have a situation that turned out to be true. I was talking about this with Lisa Abramowitz from Bloomberg, and I posed the question to her, and sure enough, the next day it came out. This was like middle of last week. It came out that from market participants, unnamed because it's supposed to be confidential, but it wasn't, and it was printed in various publications, that it was indeed China and probably some other central banks that are in there through other participants clandestinely selling their holdings in treasuries. Okay, now we reported this, but our readers don't seem to have remembered this. Okay, I get the question every day for the past week, including on today's branch visit. There's something wrong with the bond market. It's not rallying like it should on this flight to quality. Is the bond market telling us something? The bond market is definitely telling us something. It's telling us two things. It's telling us that EM central banks are selling their treasuries to repatriate currency to defend their home currencies. And it shows us that there is a flight to safety going on. Think about it. If China and other emerging economies were reducing their treasury holdings to repatriate capital from dollars to their home currency, you would expect a pretty big sell-off on the long end of the curve, right? But instead, it's trading in a range, 212 to 222, thereabouts, 213 to 222. That's telling us something. It's telling us that for almost more or less for almost uh, every sale that the central banks make, there's a buyer on the other side, right? It's holding in. If the central banks weren't selling, right, we'd probably see a 10-year below 1 again. If there weren't buyers on the other side, legitimate buyers, the selling from the central bank would probably push the 10-year through the 220s to 230. We also have other forces there. Our inflation's been low. There's no real reason for long rates to take off. And the German Bund yield is rising, and we're starting to get to a more normal, and we'll print this chart in tomorrow's report, I guess, but a more normal spread. There's still kind of line between the Bund and the 10, and the U.S. Treasury 10-year. So that's going on. But the problem is that many retail advisors and investors, mostly advisors, assume that there has to be a rotation from stocks to bonds and bonds to stocks, and those bonds to Treasury. We said a long time ago, no. It probably happens at the margins, but that's not the biggest reason. That's not the biggest motivation of the Treasury market. So there's probably some of that going on. Like I said, some flight to safety might leave in stocks and going to Treasuries, but it's not the biggest part. Now, how can we be so sure? Well, let's see if I can share these screens with you, because these are really interesting here. Let me get this up here. Is this the right one? It's hard to tell in this goofy system. And we'll share this one. All right. This is the indirect bidder participation on 10-year auctions going back to 2003. So indirect bidders are traditionally foreign central banks, pension funds, insurance companies, other institutional buyers. Right? That's who makes up indirect bidders. They don't bid directly with the Treasury. They do it through other parties, right? And those are your big institutions. Well, if you notice here, that the indirect bidders buy about 60%, have been buying about 60% of the auction. And traditionally, they've been the biggest buyers of the 10-year, all right? So that means they exert the biggest influence on the 10-year, theoretically anyway, right? So let's unshare this screen, and we'll go to another screen. And this one will be telling as well. And get this up here. If Bloomberg will cooperate. And this is the one. Okay. This is direct bidder participation. In other words, retail, mom and pop. That's who this is. These are the plain Jane retail investor or small institutions. And it's from this population, if there's any rotation in and out of equities, into in and out of bonds, swapping one for the other, is where it happens. And look at how little participation direct bidders have. Last auction, 5.8%. Here, we're about 8.5%. If we go back to 2000, end of 2014, 6.6%. We saw a spike during times of trouble, right, where they bought a lot of it. But no, they're not big participants in this market. Thus, that rotation, that retail advising wealth management is hung up on, out of bonds into stocks, out of stocks into treasuries, really happens at the margins. They are a very, very small player in the treasury market, okay? So there probably is a rotation going on, but it's minor compared to what happens on the institutional side. All right, so don't think that these clients aren't rotating. They're rotating. They're just a drop in the bucket. Okay. Now here's something interesting. Look at back in 2003, 2004. 2005 you had a jump there, but 2006, 2007, when times are good, investors don't buy a whole lot of treasuries. All right. They didn't buy it here late because treasury yields are so low, and they were told the economy is going to be robust. The economy is good. It's not robust. It's good. All right. So this whole rotation thing is flawed because so few investors, relatively speaking to the size of the treasury market, are able or willing or even should rotate from stocks to treasuries and treasuries to stocks. Just to get that out of your head, the vast majority of treasury holders are not owning them for an inverse correlation to equities. That is mom and pop. That's retail. I don't want to offend anyone, but that is amateur world. in the bond market, okay? So the people who use a modern portfolio theory, and the only reason we own bonds is to have an inverse correlation to stocks. One, it's stupid because it breaks down. You can't just make that assumption when you assume you make an asset of you and me, but that part of the market is tiny. It is minute, okay? So that has a relatively small impact on the bond market. All right. So what's happening now, from what I can tell, is that there is some rotation to safety, and there is some treasury buying by the what am I looking for? The banks. There's a buy. It's from the banks to the primary dealers. That's what I was looking for. I drew a blank. From the primary dealers, the banks who can deal directly with the Fed. Right? And there's buying from retail, but together, the primary dealers who have to buy at the auction and also use that as collateral for any positions they have and for reserve capital, okay? They buy the heck out of treasuries. So retail, between them and retail, they can offset more or less, or a good amount, of these central banks selling. Remember, not all central banks are selling. Some central banks are still buying U.S. treasuries, probably Europe. All right, so it creates an equilibrium, and that's what's being lost here. There's an equilibrium going on the long end of the curve, where buyers and sellers are pairing up and right now keeping treasury yields in the mid to high teens. Could it go to 220? Sure. Could it go to 210? Absolutely. Is it going to 2.5? Probably anytime soon. 1.5? I don't think so. All right. So we're kind of stuck where we are. All right. As I wrote in my recent reports, what's happening now is not a bear market necessarily. It could become one if people become nervous and anxious, but it's a resetting to reality. And the reality is the U.S., in spite of zero interest rates, is probably not going to grow consistently much above 3%, if above 3% at all, anytime in the near future, consistently. Well, quarters that we do it, not consistently. What's probably not in the cards either is that China experiences a soft landing and rebound. I read a report today that China still might engineer a soft landing. It's already in a hard landing, okay? When you start arresting people who are selling stocks and saying negative but truthful things about the economy and the markets, when you arrest these people, it exposes you for the bad actor that you are. So China has the problem. Okay, so that's not going to happen. But these markets are priced for China, China rising again, and the Fed keeping policies extremely accommodative until it saw outsized growth and inflation pressures heating up. And as we heard from Stanley Fischer, the Fed vice chair, last week at Jackson Hole, he said the Fed shouldn't wait until inflation overheats, until it's too late. The Fed should be ahead of the game. He's jawboning, he's firing shots across everybody's bow. All right? And it might be September, slight chance October, decent chance of December, but the Fed's probably going to tighten without inflation getting to 2, without growth consistently breaking over 3. So this whole idea that, well, the last time the Fed did this, or EM did great, and the tips did great, and floating rate was, that was different in 2004. It was different when it was tightening in the mid-90s. The economy is different, the situation is different. The Fed isn't trying to get to tight policy. It's not even trying to get to neutral policy. The Fed is trying to get to accommodative policy. That's not emergency policy. So, that's where we sit with that. Don't get all up in a tizzy about treasuries not rallying where they are, like there's something wrong. No. What's wrong is that these foreign central banks know that their goose is being cooked and they need to defend their currencies, or they will have a currency crisis. Fortunately, they can. But the good news is, even with that central bank selling, there's enough buyers to keep our rates from popping. So that's good news. All right, let's move to jobs data. We have a non-farm payrolls report on Friday. August is one of the most difficult months to predict because it has summer jobs coming off. It has school-related jobs coming on. There's a lot of noise in these numbers. You'll often see good numbers that are revised down, bad numbers that are revised higher, and usually by significant amounts. So you had ADP out today, ADP employment report. and it printed 190,000 new private sector jobs in August. It was 10,000 shy of the 200,000 expected, and the biggest loser was energy. It's funny, energy, the oil industry keeps pumping out more oil than ever. Some slowdown this week, but still a lot more oil than last year, with fewer workers, and they're getting more efficient. So, oil prices may not go to 20, they're probably not going to 60. My guess they bounce in the high 30s to low to mid 50s, depending. Right? But we saw that job slow down a bit, and we've seen job growth slow. And let's be clear, we're not seeing job contraction, we're seeing job growth slow. Well, why? Because they're probably getting to near full employment. There's probably not as much room to add workers. So that's consistent with the Fed's view that we're getting near tight labor conditions, and that maybe we're getting close to full employment. So one school of thought says, all right, we're near full employment, wait for it, we're going to see inflation. My concern is that, hey, wait, we're at full employment. This is the inflation from full employment. And that's what I think is probably the case. It might not be, but it's shaping up to be that way. Because usually as we get closer to full employment, we see inflation rise incrementally along with it. We've seen inflation nothing. I'm not just talking about headline, which is influenced by oil. Look at core inflation. Even core inflation with rent, that's measured by core CPI, it trends bounces between 1.7 and 1.8. And that's a rent's going off the charts. Rent inflation, that is. You back that out, look at PCE, 1.2, down from 1.3. When we have a more rational view of inflation, PCE is a much more rational view of inflation. Right? The Fed is not afraid that inflation is going to go out of control, but accommodative policy is warranted. Emergency accommodation is not warranted. And if it blows up some investors who bought into the EM story, bought into the junk story, I made charts today, and I showed this in past weeks. Junk spreads were blowing out. For some companies, their borrowing costs doubled in the last year. Treasuries doing nothing. You're going to see some cracks out there, I think, in the not too distant future. And the Fed's not responsible for that. Now, the people who sold their equities this week, especially if they had good large caps, and they sold into a down market, sorry to sound coarse and callous and cruel, you're going to get what you deserve. Unless, of course, you're a retirement age and you probably shouldn't have been in that many equities anyway, then that's a suitability thing. But if you did it under sheer panic for no other reason, and you were advised to, or you thought you could do it on your own without a good advisor. I know a lot of good advisors who are telling their clients not to do that. Then you're going to get what you deserve. Now, part of the problem is everybody is investing in sleeves and buckets. So when they sell, they don't own individual stocks at all, and they don't even know what holdings are in their vehicles. I'm in trouble compliance here. The equity investment vehicles at the time. So they say, sell me out equities. If it's exposed to energy, sell me out of the energy. So what happens is the trouble stocks get sold out, and the stocks like AT&T, which has nothing to do with China, like PNC Bank, which has nothing to do with China, gets sold off because they're in that bucket, they're in that index, they're in that sleeve. People, you have to be more tactical. You can't be that lazy. You can't just say, well, it's diversification. This model says it's right, inverse correlations. I'm going to let those guys run with it, and I'm going to sit back and watch it all happen. You have to be tactical. It's difficult. If you're an advisor, I know that you're tasked with so many other duties. That's what Bond Squad's here for. We'll help you with that. It's that little bit of advertisement, but we're not the only source up there. You got to be more tactical. You can't put an autopilot and let the plane hook up to the wrong radio beacon and fly you into a mountain. You can't let that happen. But I see that happening, and I bet you're going to see it happen. I don't know yet, but the robo platforms that were betting based on historic correlations that, quite frankly, don't exist anymore. It was even mentioned last week. Even Steve Leisman on CNBC suggested that maybe the correlation models between growth and inflation, Fed policy and inflation, so on and so forth, need to be redone, because it's a different environment. Mohamed El-Arian was completely right a few years back when he tagged this the new normal. It is the new normal. We're not the old normal. The old correlations don't exist. The old relationships between stocks and bonds don't exist. We're all flying by the seat of our pants using our eyes. That's what my aviator glasses on, guys. We need to fly. We need to fly right. All right? No autopilot. Hook up with somebody who knows what they're doing. Learn. It's not easy. Talk to your clients. We'll talk with you with your clients. We will not speak to the clients on their own. Those are your clients if you're an advisor. If you're unadvised, you do it on your own, you want to talk to us, that's different. We don't cannibalize our advisors. We refuse to do that at Bond Squad. So we can help you through this. We're an advantage. There are advantages out there. You don't need to just sit in this stupid model and get your butt handed to you every day. Right? We can explain why things are happening, what to expect. We might not always be right, but I will always be honest. And I will tell you how I feel. No bones about it. So we're running a little late. Please, during market hours, give us a call, email us. I'll put the contact information back up on the screen. See if this works here. There you go. That's my contact info. You can email me anytime. It's up there. That's my website. Call me during market hours. I'm here to help. There's no charge for this, by the way. If you want to just consult and see if Bond Squad can help you. All right. So with that, I like to say goodnight. And for my favorite girl out there outside of my life, Janet Yellen. Also, we graduated from the same high school at different times. Same neighborhood, same haunts. So I relate to where Janet's coming from. And we'll leave you with this tribute song to Ms. Yellen.